Greetings everyone, my name is Vas. I'm the head investment strategist at Liquidus, and this is a very short introductory video to the product that you'll find on this website. We have created a standalone absolute return trend following strategy for Bitcoin. Whether you're managing large sums of money or you have a couple of $1,000 that you can dedicate to this endeavor, I believe this still might be of value to you. We are rolling out this product just as BlackRock files for Bitcoin Spot ETF. Whatever effect it might have on the price, one thing is for certain, that Bitcoin is here to stay as a unique and alternative asset class for which you have to adopt new ways of managing your money. Buy and hold simply wouldn't cut it. It's simply lazy. There are better ways of managing your Bitcoin allocation. So let's look at this. There were two objectives when we first set out to create something like this. We have to outperform buy and hold over time and reduce downside volatility so we can allocate more capital. And in practice, the way of achieving this was to adopt some sort of trend following strategy. Because of Bitcoin's incredibly pronounced cyclical moves and its tendency to trend, the best way is to adopt some sort of trend following strategy. And that's what we did. What's the model based on? Volatility adjusted signaling process, on-chain data analysis, and cross-asset class analysis. Volatility adjusted signaling process is a proprietary signal that we created that we utilize for trading all of the asset classes. On-chain data analysis, this part of the model we outsource to another independent research company. And cross-asset class analysis is something that glues it all together and generates the ultimate signal of what we should do. Is it positive or is it negative for the Bitcoin? This is a logarithmic chart of Bitcoin, which encompasses two previous major cycles, with the history of the signal plotted on top of it, with dates alongside with returns generated by each signals rounded up to the nearest decimal point. We've started the backtest in summer 2017. Why didn't we go further back? Why didn't we start from 2016, 15, 14, maybe even at inception? Well, because those were the periods of multi-1,000% rises in Bitcoin, so any backtest would have been distorted by those numbers. It didn't make much sense to go further back. And we ended the backtest just after the FTX debacle happened in December 2022, because we believe this marks the end of the previous cycle, and right now we are in a first innings of a new cycle. So there we have it. Two previous cycles, the period of 5.5 years. And in that period, the total amount of signals we received were only 14 signals. 14 signals in a period of 5.5 years. This is why we've been able to plot them on top of the chart and make it reasonably tidy and distinguishable. And this is also great because the less signals you get, the easier it is to implement the strategy, and the less time you have to spend getting in and out of the market, less drag it creates on your performance, less slippage, less commissions you have to pay, so on and so forth. The less signals, the better, undeniably. So, out of those 14 signals, only 2 were false signals, which accounted for -21 and -7% respectively. The ultimate goal was to create something systematic that allows us to capture most of the expansionary periods whilst avoiding most of the drawdowns and preferably generating as little false signals during the periods of stagnation. Bitcoin was incredibly forgiving in this regard because of this incredible volatility characteristic and its tendency to trend. We've received only 2 false signals in a period of 5.5 years. In the future slides, I'm going to show you how we started implementing the signal. Right now, let's look at the numbers on paper. All right. This is what we ended up with. 15 signals in total over the 5.5 years period. 2 false signals, -21 and -7% respectively. Max drawdown of the strategy is -21%, compared to -84, -63, and -77% had you just adopted buy and hold approach. Cumulative return over that period was 5,420%, 834% annualized. Assuming you reinvested every single cent that you've made or lost back into the strategy without rebalancing your original size. Compared to 500, all of that compared to 518% generated with the buy and hold approach during the period of backtesting. 1,087% assuming rebalancing to the original size. assuming that size, original size, stayed constant. The numbers are incredible. We've essentially achieved what we've been striving for. We reduced downside volatility significantly, and we outperformed buy and hold approach significantly as well. Having said all that, having showed you the numbers, having showed you the backtest, we know in this business that past returns are not the guarantee of future results, and this backtest is no different. Having traded Bitcoin actively for 6 years, I've been observing the changes in character of the movements, I've been observing the changes in volatility of the underlying, and I can tell you that future volatility will decrease. Future cycles will become less and less pronounced, accounting for lower returns, and future expected return will be lower. And this chart displays the idea I'm trying to convey perfectly. This is the chart, logarithmic chart of Bitcoin going back to 2012. It breaks it down in every cycle. It breaks every cycle down to its faces, and as we can see, over time it forms some sort of a sine curve. Every cycle gets more and more muted volatility, decreasing. Therefore, with decreased volatility, future expected return decreases. The possibility of forming more false signals increase. So we have to adjust for that, and we have to expect that future numbers will look differently from the ones we see right here. But let's cut these numbers in half. Let's cut the cumulative return of 5,420% in half, and let's increase the max drawdown 2 times. So it's 42% max drawdown to the 2,710% cumulative return over a 5.5-year period. The numbers are still incredible, and we still take these numbers all day, every day, and if we will be able to generate 2,710% return over the next 5.5 period with 42% max drawdown, we will be incredibly pleased with these results. So now let's take a look at how we adopted the signal. So we first started using the signal in May of 2022 in that region. During that period, the signal was negative. All we had to do is to wait for the signal to turn positive. It did so on 24th of October 2022, right here, just before the FTX happened. We took a hit on the chin of -7%. It's all right. It's just the price you have to pay for the potential return, because the potential return is so much greater according to the backtest. We rebalanced to our original size and re-entered when the signal turned positive again on January the 2nd, 2023, right here. Since then, we are up somewhat 77%, if I'm not mistaken, broadly 77%, and we're just waiting for the signal to change, doing nothing. As simple as that. So I hope it was instructive. You can leave the feedback in the comments below, or if you want to reach us, you can do so via email. You will find at the bottom of this website. Thank you.